At 8:47 a.m., officials in Washington were still insisting the strategy was working. Television surrogates described it as tough negotiation. Advisors called it leverage. Supporters framed it as another example of America forcing a trading partner back to the table. But by 9:15 a.m., the narrative had begun to crack. By 9:32, it was collapsing in real time. What had been sold as a calculated pressure campaign against Canada was suddenly being reinterpreted by investors, analysts, and foreign governments as a costly misfire. And once markets reached that conclusion, the damage moved fast. The administration's move against Canada had followed a familiar model: apply tariffs, raise public pressure, threaten further action, and assume Canada deeply tied to the U.S. economy would eventually make concessions to restore stability. On paper, the theory looked powerful. Canada exports heavily to the United States, cross-border supply chains are deeply integrated, geography favors access. For political audiences, it sounded simple: use America's size to extract a better deal. But markets do not trade on slogans, they trade on outcomes. And the outcome beginning to emerge that morning was very different. Canada had not folded, it had adapted. Overnight signals from Ottawa suggested negotiations had stalled and countermeasures were advancing rather than retreating. Trade officials indicated alternative channels were being strengthened. Business groups north of the border were openly discussing diversification. International partners were signaling willingness to deepen commercial ties. Instead of isolating Canada, Washington appeared to have accelerated Canada's search for other options. That realization hit financial markets like a wave. Futures turned sharply lower before the opening bell. By the time cash trading began, the Dow Jones Industrial Average dropped quickly as industrials, transport companies, and manufacturers absorbed selling pressure. The S&P 500 followed lower, while volatility indexes jumped as traders rushed to hedge against deeper uncertainty. This was not panic caused by one tariff headline alone. It was repricing caused by a bigger fear that the strategy itself was failing. Currency markets delivered their own message. The U.S. dollar moved unevenly as traders reassessed future growth expectations and political credibility. The Canadian dollar, after early weakness, found support as investors judged that Canada might emerge more resilient than expected if it successfully diversified trade relationships. In global finance, currencies often react less to speeches than to perceived bargaining power, and bargaining power was shifting. Bond markets signaled caution too. Treasury yields moved as money searched for safety, reflecting concern that escalating trade conflict could slow growth, disrupt investment plans, and damage business confidence. When bond traders start pricing caution, Washington pays attention. Equities can be emotional. Bonds are usually colder. Sector reactions were even more revealing. Automakers fell on fears of higher costs and supply chain disruption. Railroads and logistics firms faced uncertainty over freight flows. Agricultural names weakened as investors considered retaliation risk and export exposure. Retailers with imported goods faced fresh margin concerns. Markets were saying something clear: in a deeply integrated economy, pressure applied abroad often returns home. Television networks switched instantly into breaking news mode. Anchors spoke of unexpected market turbulence. Analysts debated whether the White House had miscalculated Canada's leverage. Former trade officials warned that uncertainty itself was becoming the biggest cost. Business leaders called privately for clarity, consistency, and a path back to negotiation. Corporate boards can plan around taxes, regulations, even recessions. What they struggle to plan around is policy chaos that changes by headline. And that morning felt chaotic. The political symbolism made it worse. Canada is not a distant rival with limited ties. It is one of America's closest economic partners. If a pressure campaign against Canada was producing market losses, strategic backlash, and signs of diplomatic drift, then investors had reason to ask a larger question: if this strategy struggles here, where does it succeed cleanly? That question spread quickly across trading desks. Confidence is fragile because it is built on assumptions. One of those assumptions had been that Washington's pressure tactics would produce quick wins. Another was that Canada had few alternatives. Both assumptions now looked weaker. Once assumptions weaken, valuations follow. This is where the story became bigger than trade. It became about credibility. Markets can absorb bad news surprisingly well when rules are clear and outcomes are understandable. They can even absorb conflict if investors believe there is a strategy with an endpoint. But when leadership appears to be improvising inside a system of rising costs, markets become less forgiving. They start discounting future promises and pricing present risk. By midday, the administration was still defending its position publicly, But the screens told a harsher story. Stocks were lower, volatility higher, analysts more skeptical, and allies more uneasy. The move intended to project strength was now creating visible weakness in the one arena leaders cannot easily spin, real-time markets. And then came the development that turned a bad morning into a dangerous one. Word spread that Warren Buffett had privately expressed concern about policy-driven uncertainty and avoidable economic friction. Even before any formal remarks, the mere possibility of a Buffett warning electrified Wall Street. Because when markets are already nervous, calm voices matter most. What started as a trade tactic had become a financial event. What started as leverage was being priced as liability, and the collapse that shook markets was only beginning. From the beginning, the strategy looked simple enough to fit into a headline. Use America's economic size, apply pressure through tariffs and public threats, and force Canada back to the negotiating table on weaker terms. Supporters called it leverage. Advisors described it as hard bargaining. Political allies said previous administrations had been too soft, too patient, too willing to accept imbalances. This time, they argued, Washington would negotiate from strength. But strength in politics and strength in economics are not always the same thing, and that difference is exactly where the Canada strategy began to fail. The plan depended on one central assumption: Canada needed the United States more than the United States needed Canada. On the surface, that seemed reasonable. Canada sends a large share of its exports south. Cross-border trade is enormous. Supply chains between the two countries are deeply integrated. Geography naturally favors access. If Washington tightened the screws, surely Ottawa would eventually bend. But strategies built on percentages often ignore incentives. Canada's leaders did not need to eliminate dependence overnight. They only needed to reduce it enough to weaken Washington's leverage. And that process had already begun long before the pressure campaign intensified. Over recent years, Canada had quietly invested in something markets value more than rhetoric: optionality. Trade relationships with Europe had expanded. Asian demand for resources and agricultural goods had grown. Infrastructure discussions around ports, pipelines, rail corridors, and export capacity had increased. Strategic sectors such as energy, minerals, and food production gave Canada bargaining assets that extended far beyond one border. So, when Washington escalated pressure, Canada did not face a binary choice between surrender and collapse. It had a third option: diversify faster. That is where the White House misread the moment. Pressure works best when the target has no practical alternatives. If a company has one supplier, the supplier has leverage. If a nation has one buyer, the buyer has leverage. But once alternatives become credible, leverage starts shrinking immediately, even before they are fully operational. Every new customer, every new route, every new investment discussion weakens the original threat. Canada understood this. Instead of responding emotionally, it responded structurally. The second flaw in the strategy was the assumption that pain would flow only one direction. In reality, modern trade networks are interconnected systems. Tariffs on Canadian inputs can raise costs for American manufacturers. Disruption at the border can slow factories on both sides. Uncertainty can freeze investment decisions in Detroit, Michigan, Ontario, Alberta, and beyond. Farmers, automakers, transport firms, retailers, and energy users all feel ripple effects. This means pressure abroad often returns home disguised as inflation, slower growth, or lower profits. Markets recognize that quickly, even when politics did not. The third mistake was underestimating psychology. Trade negotiations are not just spreadsheets and customs codes. They are also about domestic politics, national pride, and credibility. Public threats may energize supporters at home, but they can harden resistance abroad. No government wants to appear bullied into concessions under cameras and headlines. Once the confrontation became public and personal, Canada's room to quietly compromise narrowed. Leaders who might have traded flexibility in private now needed to demonstrate resolve in public. Pressure that was meant to speed agreement instead made compromise politically harder. Then came the timing problem. Global supply chains were already more fragile than in previous decades. Businesses had become increasingly aware of geopolitical risk, concentration risk, and policy volatility. Many firms were already looking to diversify suppliers and markets. By escalating at that moment, Washington may have accelerated trends already underway. Companies that once tolerated concentration began treating diversification as urgent. In effect, the strategy may have subsidized the very behavior it sought to prevent. There was also a credibility cost. Repeated threats can be effective if they are rare, precise, and tied to clear objectives. But if tactics appear unpredictable or goals keep shifting, counterparties begin adapting rather than conceding. They ask not how do we satisfy this demand, but how do we reduce exposure to this relationship? That shift is dangerous because once trust erodes, even future cooperative offers are discounted. Canada's response suggested exactly that mindset had taken hold. Warren Buffett has often emphasized that trust takes years to build and minutes to damage. Trade relationships work similarly. Reliable partners attract investment. Unpredictable environments invite hedging. Markets can handle taxes, regulations, even recessions. What they struggle with is uncertainty about the rules themselves. That became the deeper story of the Canada strategy. It was not just a tactical dispute. It was a signal about reliability. Supporters of the strategy argued toughness was necessary and that short-term pain could deliver long-term gains. That argument can be valid under certain conditions, but only if the target lacks alternatives, domestic costs remain contained, and credibility increases rather than declines. In this case, Canada had alternatives, domestic costs were rising, and credibility was under pressure. The conditions for success were weaker than advertised. By the time Canada announced major new partnerships and markets began repricing the balance of power, the strategic verdict was becoming clear. Washington had tried to exploit dependence. Instead, it motivated independence. It had tried to isolate a partner. Instead, it encouraged diversification. It had tried to project control. Instead, it revealed limits. That is why the strategy failed. Not because pressure never works, but because pressure without accurate assumptions can backfire spectacularly. In economics, leverage is real, but so is adaptation. And when leaders underestimate how fast others can adapt, leverage turns into liability. As markets struggled to process the collapse of Trump's Canada strategy, one name suddenly rose above the noise. It was not a cabinet official, a party leader, or a television pundit. It was Warren Buffett. In moments of political chaos, markets often ignore dramatic voices and listen for calm ones. And few voices carry more weight in American finance than Buffett's. For decades, investors have treated his comments not as slogans, but as signals. He rarely speaks in panic, rarely chases headlines, and rarely wastes words. That is why when reports emerged that Buffett had issued a warning about the growing trade turmoil, Wall Street paid immediate attention. The timing mattered. Stocks were already under pressure. Analysts were downgrading expectations. Trade desks were trying to calculate whether Washington's confrontation with Canada had become more than a temporary dispute. Then came Buffett's message, delivered in the measured tone that has made him one of the most trusted figures in global markets. According to those familiar with the remarks, Buffett warned that self-inflicted uncertainty can become one of the most expensive forms of economic damage. He did not need dramatic language. The point landed because it was simple. Economies are strong when businesses can plan. They weaken when leaders make planning impossible. That idea has always been central to Buffett's philosophy. He has built an empire by valuing durable businesses, predictable cash flows, and management teams that think long-term. Sudden policy shocks run against that entire framework. Investors immediately began dissecting what Buffett likely meant. On the surface, the Canada conflict was about tariffs, trade leverage, and negotiations. But Buffett's warning pointed to something deeper: trust. Companies make investment decisions years in advance. Manufacturers build factories based on expected input costs. Railroads expand networks based on expected freight demand. Retailers negotiate supply contracts based on expected pricing stability. When government policy becomes volatile, those decisions slow down. Capital hesitates. Hiring pauses. Expansion plans get delayed. The damage often begins before any tariff is fully implemented because uncertainty itself acts like a tax. Buffett has said versions of this for years. Markets can survive recessions, inflation, and even wars when they understand the rules. What they struggle with is confusion. Confusion cannot be modeled cleanly. It cannot be hedged perfectly. It creates fear because no one knows where the next move comes from. That was exactly the atmosphere now surrounding Washington. Trump's supporters argued that aggressive tactics were necessary to force better trade terms. Buffett's warning did not necessarily reject toughness. It questioned cost. Hard bargaining can be rational, but if the method creates more collateral damage than value, then it becomes poor business. Buffett has always viewed economics through incentives. If your strategy encourages allies to diversify away from you, punishes domestic companies, and frightens investors, then the incentives are misaligned. That is not strength. That is friction. His remarks also carried unusual significance because Buffett has long represented a certain kind of American capitalism: patient, disciplined, productive, and rooted in confidence rather than noise. He does not rely on political theater. He relies on math, temperament, and time. So when someone like Buffett appears concerned, markets interpret it differently than they would a partisan critic. He is not seen as trying to win a news cycle. He is seen as trying to protect value. Financial media reacted instantly. Networks replayed prior Buffett interviews about tariffs being acts of economic friction. Commentators connected his earlier warnings to the current crisis. Portfolio managers cited his remarks in client notes. Social media amplified simplified versions of the message. Buffett warns Washington, but behind the headline was a sharper truth. He was warning not just about one dispute with Canada, but about governing through instability. There was another layer to the message as well. Canada is one of America's closest trading partners. If instability could emerge so sharply in a relationship this integrated, then investors had reason to worry about future negotiations elsewhere. If allies become uncertain, they diversify. If counterparties diversify, leverage falls. If leverage falls, future confrontations become costlier. Buffett likely understood this chain reaction better than most politicians because it resembles corporate reality. Suppliers who lose trust seek new buyers. Customers who face unpredictability seek new vendors. Nations behave similarly. Inside Washington, the warning created discomfort. Critics of the administration seized on it as validation that the strategy had failed. Supporters tried to dismiss it as elite financial anxiety disconnected from political realities. But even many allies understood the problem. Buffett's stature meant the comments could not be easily ignored. He had translated market fear into plain language the public could understand. The most powerful part of Buffett's warning may have been what he did not say. He did not predict collapse. He did not call for panic. He did not attack personalities. Instead, he returned the debate to fundamentals, confidence, predictability, and long-term thinking. In doing so, he exposed how far the conversation had drifted into spectacle. Markets are not strengthened by anger. They are strengthened by clarity. Businesses do not invest because leaders sound tough. They invest because future conditions appear knowable. That is the lesson Buffett has embodied for generations. By the closing bell, Washington was still arguing politics. Markets were still digesting losses. Canada was still pursuing alternatives. But Buffett had changed the frame of the story. It was no longer just about tariffs or negotiations. It was about whether America was creating avoidable uncertainty at its own expense. And when Warren Buffett asked that question, the world listens carefully. By the time markets closed, the political crisis inside Washington had become impossible to ignore. Trump's Canada strategy was already under pressure after signs of collapse, but Warren Buffett's warning transformed an economic setback into a credibility emergency. A failed tactic can sometimes be spun. A market sell-off can sometimes be blamed on outside forces. But when one of the most trusted investors in the world publicly warns about self-inflicted uncertainty, the room for political denial shrinks fast. Inside the White House, officials understood that immediately. This was no longer just a trade dispute with Canada. It was now a domestic battle over competence, confidence, and control. Senior advisors were pulled into urgent strategy sessions. Economic staff wanted to know whether the market damage was temporary or the beginning of something larger. Political aides focused on headlines showing Buffett's name next to warnings about Washington. Communications teams scrambled to craft a response that could calm investors without looking like retreat. In politics, narrative moves quickly. By afternoon, the narrative was already shifting from Trump pressures Canada to Washington loses control. That kind of reversal is dangerous because it spreads beyond one issue. The first instinct inside the administration was resistance. Some officials argued Buffett was exaggerating. Others claimed Wall Street always overreacts to short-term news. Supporters on television framed the turmoil as proof that entrenched interests dislike tough negotiation. But those defenses collided with a hard reality. The market reaction was visible, measurable, and immediate. Stocks had swung sharply, business leaders were voicing concern, and analysts were openly questioning the strategy. Dismissing that as noise was difficult. Treasury and Commerce officials reportedly began assessing sector-by-sector fallout. Automakers worried about supply chain costs. Manufacturers feared retaliatory disruptions. Farmers watched export markets nervously. Retailers faced pricing pressure. Transport companies were uncertain about freight volumes. Canada is too integrated into the American economy for a confrontation to remain abstract. Every tariff threat at the border can echo through warehouses, factories, trucking lanes, and consumer shelves. That made the White House scramble more urgent. This was not a symbolic dispute. Real industries were involved. Congress quickly entered the scene. Lawmakers demanded briefings from administration officials. Members from farm states asked whether export markets were being endangered. Representatives from industrial regions wanted to know if jobs were now at risk because of a strategy sold as strength. Even some allies of the president privately worried that Buffett's warning had legitimized broader criticism. They could defend hard bargaining. It was harder to defend avoidable instability. Opposition lawmakers were more direct. They accused the administration of mismanaging a relationship with one of America's closest partners and creating market damage for political theater. Calls for hearings began circulating. Committees discussed summoning trade officials to explain the plan, the fallout, and the next steps. In Washington, policy failure can often be buried under new headlines. But when Congress senses weakness, scrutiny multiplies quickly. Inside the West Wing, the central debate narrowed to two options: escalate or recalibrate. Escalation meant doubling down stronger rhetoric, new tariff threats, claims that Canada would eventually fold. That path might energize supporters in Project Defiance. But it also risked another negative market reaction and deeper business backlash. Recalibration meant reopening quieter negotiations, softening public language, and searching for an off-ramp that could stabilize confidence. That path might help markets, but it carried political risk because it could look like retreat after months of tough talk. This is the trap of public pressure campaigns. Once strength becomes branding, flexibility becomes harder. Buffett's warning made that trap more visible. He had not attacked personalities or chosen sides. He simply reframed the issue around competence and incentives. Strong economies need predictability. Businesses invest when rules are understandable. Markets punish avoidable confusion. Those are difficult arguments to counter because they are rooted in fundamentals rather than ideology. White House communications teams tested multiple messages. One version emphasized long-term gains and short-term pain. Another claimed Canada needed the U.S. more than the reverse. A third focused on blaming media panic. None fully solved the core problem. Investors were reacting to uncertainty, not messaging. Money does not read talking points the way voters might. It follows incentives. International allies watched closely as well. If Washington appeared rattled by a single failed pressure campaign and one investor warning, future negotiations elsewhere would become more complicated. Credibility in diplomacy depends partly on whether threats look sustainable. If markets punish those threats, leverage weakens. Foreign governments understand that. By evening, the administration still projected confidence publicly. But behind the scenes, the scramble continued. Staffers reviewed market data, policy options, and political fallout. Calls were made to lawmakers, business leaders, and advisors. Officials searched for a way to regain initiative without admitting miscalculation. That is one of the hardest tasks in politics, changing direction while pretending you never needed to. The deeper lesson of the day was brutal in its simplicity. The collapse was economic. Buffett's warning was political. Because once markets moved and Buffett spoke, the issue was no longer Canada. It was whether Washington understood the cost of chaos. And in the capital city where perception often shapes power, that question hit harder than any tariff ever could.